Hi everyone, thanks so much for tuning in. I'm Hans Pearson, CEO of the Store Local Group.
And I'm Mark Gregg, I'm the National Head of Revenue for Store Local.
In light of recent events, we thought we'd get some experts from all around the globe to share their experiences and give us something to take away and apply it into our businesses over the coming days and weeks.
We're really excited, so let's get into it.
Hi everyone, welcome back to StoreCast, brought to you by Store Local here in Australia. Delighted to have episode 13 today, and all future episodes you can find on our website storelocal.com.au/StoreCast and browse through the various people that we've interviewed over the last 6 months through COVID all around the world in Europe, the US, Asia and Australia. So please take your time to have a look, and today we've got another great episode, and we're focusing, interestingly, on the area of self-storage valuations. And we've intentionally left this hot topic for some time so that we can get a really good read on the market coming in through and then potentially starting to come back out of COVID in a lot of markets. And unfortunately, in some markets, potentially being dragged on by a resurgence of those market conditions. So it should be a good topical discussion, and hopefully there's some really practical takeaways and some thought-provoking learnings we can have. So delighted to have a couple of special guests. Ross Perkins, Managing Director of M3 Property, one of the leading self-storage valuers here in the Australian-New Zealand market, and has been in the game for quite some time. Welcome, Ross. And also Linda Sharkey, also one of the, of regard Ross and Linda as the two leading valuers in the Australian self-storage market, and Linda is a director at Urbis based in Sydney, and both Ross and Linda have a nationwide role and do work in Australia and New Zealand with the major brands and independent operators as well. So welcome, Ross. Welcome, Linda. Linda's outdoors there on just north of Sydney, near Newcastle, I think. Is that right?
I'm on the Central Coast, we're not too far away.
Central Coast, and enjoying a bit of outdoor activity, which is great. And I'm delighted to have my co-founder, director, and Store Local's Chief Investment Officer, Rob McTaggart, join us as well from Brisbane. And Rob has a long background in property valuation in a range of disciplines, and in Store Local's in charge, responsible for our acquisition and development programs. So welcome, Rob.
Thanks, Hans.
So let's dive straight into it. We don't have a lot of time, and we really appreciate the time that you've all made available. I guess just to open the discussion, and then I'll leave Rob and others to progress the discussion along. This has been unprecedented times, there's no doubt. We're coming into Christmas and post-Christmas with a head full of steam in terms of cap rates. In the Australia-New Zealand market, we've seen increasing, we saw an increasing trend towards sort of flat rents and yields, yet the hunt for stock was at a level that was continuing to compress cap rates, and also seen an emergence of more multi-level stock versus more traditional ranch-style product, and really the strong emergence of a top tier of nationwide operators, and then really strong single city-based operators, and then a whole range of independent operators from one end of the country to the other. So the industry is really finding its feet in an institutionalised way, and then of course we've had the unprecedented impact of COVID-19, not just in Australia but elsewhere. And what I'm really keen to understand from Ross and from Linda, what have you seen in terms of market dynamics from mid-February until now, both in the unlisted and listed space, and if any commentary, whether that's around cap rates, discount rates, which Rob can dig into in a bit more detail as we go forward, or just general market behaviour.
Yeah, I think can I go first? Yep. Just looking at it, if you go back to pre-COVID, I think there's 5 or 6 factors which were driving all property sectors pretty strongly. And that was the weight of money, lower for longer interest rates, property being seen as a safe investment compared to other investment opportunities. And then you had a very strong economy and good population growth generally throughout Australia. So since that time, we've had a couple of things that have changed, and like lower for longer interest rates are still here to stay. So I think that's a positive. The weight of money is still out there, and property is still seen to be a good investment. So I think from that point of view, I think that we're not going to see much slippage in yields going forward, because all of those factors are still in play. And so, yeah, we don't see a lot of yield slippage coming out of all this, but other factors obviously could impact on values.
Yeah, Ross, I've it's an interesting thing on the cap rates, and if you look at cap rates, they are, I don't want to be too theoretical, but they're the sum of the risk-free rate plus a risk component for the asset, and the risk-free rate has dropped from a high of 16% in 1982 down to sort of less than 1% where it sits today. And as you said, that has yields have followed. They've compressed downwards, and all real estate sectors have enjoyed that benefit.
Yep.
Plus, there's the weight of money. There's that continuing increase of superannuation money flowing into super funds every day, all looking for a home. But I sort of, we're developing a sort of hypothesis internally that we think we might be sort of at a bit of a fork in the road at the moment, because the risk elements around an asset are tied to the income and its management. And if you sit here today and say, well, the disruption in commercial real estate, in retail property, hotels has been quite severe, whereas storage is just being resilient and it's just stayed true, and really, we haven't really missed a beat. And so I'm just wondering whether, or we're sort of starting to think, well, are we going to start to see storage cap rates decouple from the relationship they've had with other real estate investment sectors, in that either storage cap rates will stay the same and other cap rates will soften, or storage rates, the cap rates will start to firm even more as the investment market see, well, the income is secure, it's a real estate backed investment, and there's that weight of money starting to flow around looking for a home, saying, well, we actually don't know what's going to happen with commercial rents moving forward. Retail is significantly disrupted. So I just sort of put that out there. That's a sort of a hypothesis we're developing internally, that we think where self-storage cap rates are sitting right now, we think there's going to be some further movement, either in a relativity to other cap rates or in real terms, that they'll firm even more.
Well, I think there's certainly that potential there, Rob, but I think you're already seeing yields in some property sectors softening already, whereas in both in industrial and also in self-storage, we're not seeing any decompression at all at this stage. So we tend to agree with you. I can't see there being a lot more movement downwards in yields, though. But I've said that before too, by the way.
Yeah,
I've been wrong. So, but it's how low they can go, I think, as much as anything. But certainly retail and hotels and all of those sectors that have been hit hard, I think they're already starting to show signs of decompression.
Yeah, and I tend to agree. I mean, at one stage we thought we were at the peak of the cycle, and we expected cap rates to definitely stabilize and not compress any further. But at each sale that we transact, even now, they're continuing to sharpen. So, feeling that, as well as the lack of property that's available to purchase, and then the greater interest in alternate assets as well. So we see a lot of publications and a lot of market reports that aren't necessarily written by those in the industry, so not written necessarily by us or by M3, but there is a lot of talk about alternate assets at the moment being a safer place to invest and having that higher return. So I actually think we're going to see more and more interest, and potentially there's scope for further sharpening, which we probably wouldn't have said 18 months ago.
Yeah, I sort of tend to agree. And you know, when we look at, as an example, we look at the Abacus results that have come out, and there's public document, and you know, Abacus are a blue chip company. They've got great assets, and the sort of average cap rate for their self-storage, and also the great thing about Abacus is they've got self-storage portfolio, they've got an office portfolio, retail, so it's the same management structure, and they have got great assets, and they're a blue chip company. The self-storage average cap rate 6.6% in their portfolio.
Yep.
The office is 5.5%. So there's a 110 basis points difference. But if you take out the risk-free rate out of those, so you're saying, well, the risk premium that have been associated to the cap rates for those assets, for the storage is 5.5% and the office is 4.4%. So they're basically what the market is saying in that assessment of value. I'm not saying it's wrong, but it's just the relativity at the moment in the market is the market is in that portfolio saying there's 20% more risk in the self-storage portfolio than the office portfolio. But the self-storage income moving forward, we've seen has been fairly resilient. So I just think that sort of relativity, to me, seems a little bit out of whack in that respect. And whether we get, as you say, with Linda, their peers on that basis, more sharpening of the cap rates in the storage portfolio. You would think, and that then you'd sort of look at sort of asset sector by asset sector, and then consider the Abacus office income, nearly 50% expiring the next couple of years, so on their leases. So there's quite a lot of risk around the security of that income. It's fairly heavily disrupted, that sector. So
yeah, I think it's important to think about cap rates as risk and return. So risk is definitely one large component of it, but return is another component. And what we've seen since capitalization rates started to compress is that fight for return, and then obviously outweighed with risk. So that compressed office rates to rates that were more in line with retail rates before. Now, obviously, the retail sector is in a completely different dynamic. But I think as self-storage becomes more accepted as an asset class and matures, although I do think it's already matured in Australia, but continues to mature, then you're going to have more investors chasing that high return, which brings down cap rates further.
Yeah.
So, and that's what's happened in the office sector and the retail sector and the more traditional asset classes for some time. I think, although office is a really good comparison, I think it's really interesting to watch the industrial cap rates, which continue to compress in the downturn, as Ross rightly pointed out. And I think there's going to be a broader or a less spread between the industrial and the self-storage cap rates moving forward. And there's possibly more compression to occur in industrial as well, with the demand that's there now through COVID. So yeah, it's important to think of them together, but it's also what the investors are chasing. And I think there's just a bright spotlight on alternate assets at the moment, which will drive that demand.
Yeah, I'd agree with that too. I think the office market in reality is in a world of pain, or coming into a world of pain, just with structural changes to demand.
yeah,
Whereas it's, as we just mentioned, the industrial market is probably more aligned to the self-storage sector. Back when we first started out valuing self-storage assets back in the mid-90s, there was no sales. So we used to use multi-tenanted industrial sales.
right.
Yes.
Ross, I remember when we started investing 10 years ago, the banks would require an alternate use valuation because what if storage doesn't work? and that's well in the rearview mirror now. I guess just to pick up on that thread, Linda, and I'll sort of look at discount rates as well, but what's underlying all of that? You talk about risk and return as the income streams, right? And the other feature of the Abacus results, there was a report by Macquarie today, Macquarie Bank, they identified the 3 different sectors that Abacus have within their portfolio, which is it's a really handy sort of segmentation to be able to draw a direct comparison between the sectors from. And in their retail portfolio, they recovered below 50% of the rents, in office 90%, and in self-storage 98%. So nearly 100% of revenue actually collected. So the arrears are minuscule, and we all know that, and we're used to that. But then overlay on that the tenant risk, within the Abacus portfolio of 80 odd stores, although they're predominantly unreported on 57 of them, but go for the 70 odd to 80 stores, the number of tenants across there is in the 10, 20, 30,000. So the diversity of the income is, and the reliability of the income is really significant, clearly. So with that and the risk-free rate, how do you then look at discount rates when you do your DCFs? How are you treating those future income streams in self-storage?
Yeah, that's a good question, Hans. And it's important to look at what growth was doing, what rental growth was doing prior to COVID to get the answer to that question. Because as you know, we have the Urbis Storage Index, which gives us, I suppose, 1 point of measure for rental growth. And prior to COVID occurring, so when I talk about the December 2019 result, we had already recognised that rental growth was subdued. And in some regions, it was actually negative growth. And that has continued as we reissue the index. There's an issue about to come out. We've just looked at the 30 June data. So rental growth was subdued prior to COVID hitting, and then obviously COVID hasn't helped things. And the discount rate is fundamentally a measure of return over the 10-year cash flow or 5-year cash flow, whatever it is that you choose to do. We generally do a 10-year. And year-on-year growth as well included in that. So what we like to see is, 2.5% is good growth these days in terms of revenue. We haven't seen that in the last 12 months. We are projecting that growth will be subdued over the next 2 to 3 years in most regions because of COVID hitting, and then we're predicting that rental growth will return thereafter. Will it go back to 2.5, 3.5 levels? I'm not entirely sure, but that is all factored into the discount rate that we apply. So we know roughly what's going to happen over the foreseeable future. So when I talk about foreseeable future, I'm talking about that 2-year near term. And then after that, you try and predict what's going to happen in the market. So we are looking at that 10-year rental growth stream when we apply our discount rates. Now, as you know, we get our discount rates from how we analyse evidence, and most of the sales evidence that we've been analysing is pre-COVID hitting. So we do have to look at that too. However, we have a number of transactions that we are aware of that have occurred throughout the COVID period, and we have no reason to amend those discount rates or those cap rates based on the sale prices that have come through. So for now, it's the same as it was before, but we are slowing that growth initially to reflect what's actually happening in the market.
Yeah, and we're doing very similar things. We're predicting no growth, exactly what you said, actually. It's quite ironic. We're saying no growth for 2 years. I think we've got a slightly negative growth for the next 12 months. That's only very minor. And then we foresee it picking back up and going back, running along with CPI is what we're doing at the moment.
And what do you see impacting that growth? The general economic growth, clearly, perhaps population growth. I'd love you to talk a bit more about discounting and how we can share some experiences in our own portfolio over the last 6 months. But discounting clearly has been required in order to maintain occupancies, but it's just a question of how much.
Yeah. You want to go first, Linda, then?
You can go with the discounting. I was going to jump in about the growth, but far ahead. That's fine.
Yeah, well, discounting has been a feature of the market for a long time, as you know, but I think as occupancies go down, obviously discounting could increase. We'd expect it to, but we don't really expect it to be material. We're seeing discounting of up to about 7% as being fairly normal, a normalised market. But I think it depends, like it just depends on the strategy of the owners, really.
Yeah, so
And
when we talk
yeah.
about discounting, we discount from rack rate being one thing, but also the concession rate as well, that we have a very keen eye on, particularly in times like this. And where we see that concession rate, and that's the buy 1 month, get the second month half price, or whatever the offer might be, we see that really rising in highly competitive areas. So the correlation between rental growth and new supply is quite strong. I've recently done a number of these exercises for the Self Storage Association State of the Industry research piece that will soon be released to the market. And there's some really compelling correlation pieces in there where we've actually looked at the 10-year trend over the Urban Storage Index to find a correlation between new supply, in particular in the major markets, population growth where we could, and the most interesting one actually is new residential releases to the market. So that when I talk about new residential, I'm really relating to apartments, so new apartment releases to the market. And we see spike in revenue growth when there's new apartments released, particularly when the volume is greater than the year before. And when new supply is strong, we generally see revenue growth retreating back in those regions. So that's quite an interesting trend that we have been watching for some time, particularly that new supply story. As we know, there's quite a few new sites popping up and have been for a number of years now.
What about with the, we're starting to see more sort of developers, sort of real estate developers that traditionally have been focused in the traditional sectors of industrial and retail and office, now starting to look at the self-storage sector. Are you seeing that as quite a strong trend across the country, and what is sort of, what outcomes do you think will result from that?
Yeah, it's interesting. We have had a lot of new inquiries about self-storage since COVID hit, particularly when restrictions eased in most of the cities, and I guess the strategy of most portfolios might have changed or shifted slightly. And we are seeing non-traditional self-storage developers wanting to get into storage. Whether they do or not, I believe it was a similar trend in the GFC, and there was a lot of talk about it, but whether they actually proceed or not is another question. But out of the ones that we have taken inquiries from, they seem to be pretty serious, and they seem to be pretty cashed up. So the cash is there and the interest is there. It's just whether they can get a hold of the assets or not. And I think there's a lot of investment funds popping up, and also traditional independent investors that are coming together, trying to be the next national storage. Now, whether that's possible or not, would be interesting to watch. But I think that we're going to see more of that trend. Definitely more non-storage developers and investors coming into the market. Yeah.
So I guess the risk is that we could move to sort of quite an potential oversupply of assets.
Yeah, the real risk is because there's lack of stock available to purchase, and even if you did approach the right owners, the likelihood is some of the other major acquiring parties have already spoken to them. So because of that lack of stock, the next option is to build. So what we might see is a lot more building happening, and that feeds into that new supply story that we've been talking about for some time, which will most likely constrain fee rate growth. And of course, we have this population growth dynamic happening now where we're not seeing that new population coming through. So it'll be interesting to see how each state responds to that, particularly as immigration has slowed. But really, it's the type of population that's moving into an area to determine if they're going to use storage or not in any event. So whether that overseas migration is going to have a major impact, we're watching that closely. But really, if it's an interstate migration story or whatever the case may be, that's probably the only saving grace is having that population strong. And who knows, with COVID, that's likely to be slow in the near term.
How are the banks responding to these sort of new developers, developers coming into this new sector for them? Are you seeing them applying any sorts of specific terms and conditions or requirements, or generally happy to lend on the standard sort of LVR basis? If they've got enough cash, they'll lend the money and they can go ahead and build it.
Yeah, I think you hit the nail on their head there. If they have enough cash, I think it's to do with LVRs and how strongly they're backed. And most of the entities that we find are coming to us are strongly backed with cash. So I think that's driving it. I'm not too sure the banks are all that involved in some of them, and where they are, they seem to proceed. I mean, they generally do a lot of research first, and we haven't seen, I guess, this new wave of entrance to the market progress to that stage yet. But they're discussing it with the banks, and the banks seem to be open to that discussion. I think when I mentioned the maturity of the asset class before, I think the banks are actually accepting that as well. So we have some really keen lending happening with the major banks looking for storage customers, probably because of the resilience of the asset.
Yeah, that makes sense. We haven't seen that much in Queensland of new construction by new players to the market. It tends to be more where, like your majors are actually buying the asset off and funding it through type thing. The way, I think the fact that it takes 3 years to fill or 4 years to fill puts off a lot of developers, because they just don't want to wait 3 or 4 years before it gets to maturity, and there's not a lot going under lease anymore.
And I guess the traditional development model is that, ideally get a pre-commitment to for an industrial property or a commercial property or a retail property, get a pre-commitment to a national tenant on a 10-year lease, and then they can fund it through or sell it on, build it and sell it on completion. So that sort of 3-4 year lease up negative cash flow component is probably, from the discussions we've had, it's been a little bit, it's new territory for them.
Yeah, takes a different mindset, I think, doesn't it?
Yeah.
Right, developers inherently traders, right? And they want risk instantly and then move an asset on, which is an entirely valid approach to development. And storage, I mean, we're about to start the construction of a 4-story greenfield site here in Brisbane, just near the Brisbane airport. And, they're long, slow burns. That's life. But I guess certainly Rob and I and our investment group have become used to that. I wouldn't mind picking up, Linda and Ross, on the different tiers in the market. If you've got any commentary around different tiers, and there's a couple of ways we could look at that. There's a nationwide operators, there's independent operators, there's metropolitan, there's regional, and there's modern customer experience with multi-story or just very modern facilities and some of the automation coming through there. Versus some of the older stock. Any sort of segmenting of the market that you're seeing, either by banks or by yourselves as valuers, or just that the customer demand and the ability to price at different levels? I'd love to get your thoughts on any of those segments if you've got some.
Sorry, Hans, what do you mean by tiers? You're talking about quality of assets, basically?
All those things. So you've got different. So metropolitan and regional. How are they being distinguished at the moment? Is there different growth rates going on, and there's different tiers of the market with quality of property, and then there's also 2 tiers of operations. There's the nationwide operators, and then there's the independent operators. So any commentary on those sort of 3 areas would be interesting.
And also, how does that flow through in simple terms just to cap rates too? Does a regional country storage facility sort of have a higher cap rate than the same facility if it was situated in a metropolitan area, even though it's trading well and it's high occupancy?
That's right. So just a bit more context. So just to help with that discussion, our experience through COVID is our regional Australian stores have performed extremely well. And continue to surprise us. There's a whole range of either localised issues or perhaps the government stimulus has had a greater impact in those regional areas. We've yet to see how that plays out going forward. But it's and then we've got some quite sizable stores in Melbourne, which also were going extremely well coming into the end of June and have really flatlined or come down a little through the second wave of COVID, but haven't been particularly smashed at all. We've really seen different performances between regional and metropolitan, and maybe it's just an unusual set of circumstances, but anyway.
Yeah, I kind of think, like if you look at the different areas where, talking about cap rates in particular, like obviously inner city in Sydney and Melbourne, we regard as probably the tightest yields, and then, like moving out from there, probably into the, Brisbane's probably 0.25% behind for the same asset in each of the cities,
Mm-hmm.
I would have thought. And like Tasmania, Western Australia, and Northern Territory are probably at the bottom of the range, I would have thought. And, your suburban, or put it this way, regional is probably above those or at a similar level to those areas, we would have thought from a yield perspective. Yeah.
Yeah, I might just jump in, Hans. In terms of your regional assets doing quite well, and what you've made, the points that you made about the Melbourne assets, I think it's a really interesting point. It's a trend that we've picked up across the board, and I think the reason for it is sensitivity to pricing. So where storage is more affordable, it's appeared to have weathered this storm a little bit better. And if we look to other markets like the US, where storage is far more affordable than it is in Australia, there's better absorption there. So I think you'll find that where it's more affordable and where there's a certain price point that feels affordable and doesn't stand out when you check your bank account every week or every month, whenever you're looking at it, then you've got less chance of losing that customer. And I think when we speak to the broader market, some of the areas that have surprised us the most, that have lost the most customers, is where that point is at the very top end of what could be expected in that area, because it just seems like an expense that you can do without when times are a little bit tougher. So for that reason, I think the regional markets have held a little bit stronger in this respect. It's also a lot to do with the catchment as well. So we're closely looking at the type of employment in each area. We always looked at the demographics of a catchment when we're valuing an asset. We do look at population growth and those other obvious things, but we look at unemployment rate. But now we're looking at the type of employment to try and preempt what that demand might be and how that might be impacted by whatever next is coming through the impact of COVID. And then how capitalisation rates play into that, well, it comes down to demand. And we've got a very interesting thing happening in Australia, where there's a lot of demand for all assets, or most assets, if they're reasonable assets. And up until recently, we didn't see too much variance between that regional asset and the prime asset. However, I think the strategy has changed in the majors, particularly National Storage, where they are really keen to get those prime assets. And because of that, we're seeing more prime assets transact, and those cap rates are looking tighter than we would have had access to data in the past. So there seems to be a broader spread, but I actually think it's just the strategy of the major players really focusing on those prime assets. Interestingly, with the Urban Storage Index, we've noticed that the inner markets have done a lot better in occupancy. So price sensitivity being one thing, but the markets seem to have held quite strong in occupancy in those prime markets. The outer markets have slugged a bit, and I think that really fuels, the position of an asset and how a prime asset can weather most storms a little bit better than secondary assets.
I think also anecdotally we're seeing a lot of the regions have actually weathered COVID quite well also, just generally, and for what we've seen, but also even chatting to people with retail shopping centres through these regional areas, they haven't had the same impact that retailers has suffered in the metropolitan areas, I guess, through social distancing and things like that. It's just, those regions just seem to have ticked along, and I think that's sort of what we've seen in our self-storage facilities as well. But whereas the some of the outer suburban areas in the major metropolitan areas have really been hit hard from a job losses point of view and things like that.
I think it's a very good point. And even the impact of COVID. I mean, you go to outer Sydney and everyone's wearing a mask and has to wear a mask because there's so many hotspots. And here on the Central Coast, you wouldn't even think COVID exists at the moment. So it's also how that plays into confidence in the market, I think, as well, or confidence in that discretionary spend that we talk about when we mention storage quite a bit.
So I was going to say, it makes it a difficult customer transaction when the staff member's wearing a mask and the customer's wearing a mask. It's it doesn't make life very easy for anyone that's involved. Sorry, Rob, you were going to say? I
was going to say, Lynn, you mentioned that spread between prime and non-prime yields, how it was narrow and now it's sort of widened a bit. What about in terms of, is there a spread for managed platforms? So when you've got a single asset that's run by the original owners compared to an asset that's sort of under the management of a national brand?
Yeah, so we'd love to see a major portfolio transact so that we can actually have evidence to support what that spread would be or what that premium cap rate would be if it was a portfolio transaction. We have a number of small transactions or small portfolio transactions that we're aware of, and we try and analyze those, and they tell us it's in the region of 25 basis points to 50 basis points maybe. But if a major portfolio was to transact, who knows, it might be 100 basis points, it might even be more. And we got very close to that earlier in the year, and we were quite excited about seeing what that number was, but unfortunately we didn't get the answer. So yes, there is a premium there, and I think not only would local investors love to get access to a sizable portfolio or a premium portfolio, but now there's international interest and very heightened international interest as well. So I think hopefully someday we will see that, but there's definitely a premium that will be paid for it.
Yeah, we'd support that 25 to 50 basis points as well. And I think that we've analysed a number of industrial portfolio sales. That's what they're showing, about 25 to 50 basis points. So I think that's spot on.
So it sort of begs the question, I'm keen to understand from you, Linda, and from Ross, what do you think drives the performance of an asset in all of the analysis that you do? We talk about some of the regional areas which have done very well, and we've been the beneficiary in some of those, and that's just good fortune. We can't claim that. Some areas have just really taken off, and some are down. And the extreme examples are always the mining cycles in various parts of the country. And the other is the presentation of the store, its location. So there's some macro issues, in the local economy. There's some physical attributes, and then there's the management of the store. Yeah, have you got any commentary on what the key things that you analyse when you're looking to see the performance of a store, and hence any value premium or rating that you might want to put on it?
Yeah, so a few years ago, probably about 2 years ago now, we launched the Urbis grading tool, which has had various levels of uptake. But through that process, we interviewed quite a few participants. I think you were one of them, Hans, about what does drive strong performance in a facility. And from that, we determined what classifies a premium or an A grade or a B grade asset. And one of the things that came out quite strong there was the catchment. So the catchment in terms of, as I mentioned before, the demographic catchment, so the socio catchment that applies to that drive time or that 5K radius or whatever it is that you're using. But the amount of supply in the area, I think, is critical to that. So when we look at any asset, whether we're valuing it or grading it, we look at the existing supply and the future supply and try and predict if that supply can be absorbed, particularly where there's high levels of new supply. So that's the primary thing I would say. But secondly, presentation, I think, is more and more important these days. People like to go into somewhere nice. We now see really large, really well presented merchandise display areas, and those facilities have shown to have stronger other income or merchandise sales revenue because of that. So the market has matured in that respect, and we are now seeing better facilities on offer, and I think customers are choosing those better standard facilities.
Yeah, I'd agree with that. It's really the drivers of the market, isn't it? Like we've got all those factors that actually make the occupancies or prop up the occupancies or whatever. And they're all the same, we do exactly the same analysis as you guys do.
And with that customer experience that you're touching on, Linda, the automation, Ross or Linda, are you seeing an increase in automation? Surely our theory on that is, it's not unique, is the health issues at the moment are going to drive long-awaited automation of an industry that has had, because we've got high profit margins, we've had low incentives to innovate. So we haven't had a lot of innovation, and the innovation that we require to have a contactless experience is not that hard, really. And we're starting to see that come right through. Are you guys seeing the same thing? And do you think that plays into performance and value as well?
I think it will. At the moment, it hasn't really come in yet. But I think, if you look at what's happening overseas, it's certainly in Europe, it's quite strong over there. As in, you don't even need to see anyone, you just go in and it all does it for you. So which will reduce salaries and things like that as well. But yeah, I think it's certainly going to come in. I think this whole COVID thing is, as you mentioned, is actually driving or accelerating automation.
Yeah, I think the industry took probably 3 years of a step forward when COVID hit, and a lot of the major operators allowed contactless move-ins and contactless payments and automated payments and all of that. So I think that we've already taken a step forward to that. Will we see no managers in stores in the future? I'm not sure. I mean, I'm not sure that we're a culture that would want that. I think there's going to be a place for automation, and we've proven that over the past 6 months, thereabouts. But I think you'll always need that person or that face to upsell the insurance, to upsell the merchandise, to do all of those things. So, like everything that we're hearing now, somewhere in the middle is probably the answer. But we've definitely taken a huge step forward with it.
Yeah.
Well, I mean, the challenge to that, of course, though, Linda, is, you know, the banks and bank managers and ATMs and now the post offices as well. You know, it's just probably something that's going to take some time to eventually get to a point where, you know, maybe in the future there won't be any staff in these facilities. Maybe it's a 10-year cycle or a 10-year change.
There's different views there, isn't there? I mean, for us, that local focus is super critical for our management, and having someone that's deeply engaged in their local community is really important. So maybe it's a balance in between, and I always think the distinction of self-storage versus, say, hotels, which are often completely automated check-in now. You don't need to have a reception desk in a lot of them. Car parking's the same. As they're short-term transactions, you're in, you're out. Whereas storage, people have got their gear there for quite some time. So the requirement for that peace of mind, that sense of security, is different, and potentially it therefore requires that face-to-face comfort that someone might want. But not everyone. There's a number of customers that I don't want to see anyone. Contactless is the way I want, and I'm in and I'm out. But so, yeah, we'll see where that settles. But it's got to wait and play out for sure.
Yeah, one of the things that might drive it actually is the protection of revenue, because if we're not getting revenue growth because the market isn't there to allow that at the moment, and as we've both said, it could take 3 years to get strong growth again, then the next option to try and grow revenue is to reduce operating expenses. So I think potentially that might push some of it on, but there's other ways, I suppose, to reduce operating expenses, and maybe salaries isn't the first one off the list, but potentially it will be a target going forward, because it is probably one of the highest, or it is the highest usually line item in all of the operating expenses that we look at. So maybe that will drive it on further.
Look, some of the other expense items, I know you've done some analysis on this, Linda, and also Ross. The key ones are clearly marketing. And electricity is another big one. We certainly are rolling out solar across our facilities, and not a moment too soon. That I think a lot of the major operators are doing the same thing. The other is marketing, and it'd be interesting just to talk a little bit about that. I know, looking at the results from the big operators in the US, some of their marketing spend increased 40% in the last 6 to 12 months. So there's been a massive increase in the amount of marketing spend, and I don't know how they break that up. Maybe there's some discounting or concessions that are built into that as well. I don't know, but yeah, any commentary around the trends that you're seeing and the importance of marketing and or discounting in the Australian New Zealand market?
I think in all competitive industries, marketing becomes more and more important as the industry becomes more competitive. So I don't think it's one that's going to go away, because it's almost vital, and we're seeing more modes of advertising being used all the time. So you turn the radio on, you turn the TV on, and there's ads for storage on there. In order to keep up with that, everyone's going to have to do take a similar approach. So I'm not sure, even though marketing will be one that I'm sure all operators would love to reduce, I'm not sure that it's going to be that easy to do so, because the market has become this competitive. It'll be interesting to see what types of marketing. I mean, there's been some really quirky things happen in New Zealand in terms of marketing that were interesting to watch, and they've had some success. So potentially we'll see some new ideas coming through, and with social media, there might be some stronger results coming through from that sort of low-cost marketing spend. But in general, it's going to be quite difficult to reduce marketing fees, I would expect.
I think also coupled with the competition, there's the avenues of media distribution have expanded exponentially. So people are consuming media or information from all different sources. So, you know, the marketing channels are sort of tenfold compared to sort of 15 years ago when it was the yellow pages, and that was it. You know, so it's certainly to get front and center. There's quite a lot of activity that has to be undertaken.
Look, conscious of time, everyone. We've been nearly an hour, and I've loved the discussion. It's been fantastic, as it always is with you both. Are there any comments? There's Rob's dog making a contribution to the chat. My salient input today. Any other comments that you would like to close out with? Commentaries on the market, or something that our viewers might take as a good insight into the current market conditions in New Zealand and Australia?
One of the things, you go, Ross. I'm jumping in a lot. So yeah. Well, the only thing I was going to say is we always get asked, you know, where in the cycle are we? Are we at the peak? What are cap rates doing? All of that. You know, that looking for that answer to determine whether it's a good time to sell or if it's a good time to build a new store, whatever might be playing on your mind. But all I'd say is, like all property cycles, it is a cycle. And even though we may be entering a bit of an uncertain market at the moment, and that will come with its challenges, it is a cycle. So I just leave people with this positivity or positive note and a little bit of optimism that hopefully we will come out of this sooner than later, rather than later.
Yeah, I think from my perspective, I think whilst we're in a cycle, I think that once we get through this COVID period, I think it's looking pretty good going forward. You know, like I think Australia's pretty well positioned across the globe. So yeah, I think it's a good period for us.
Rob, any comments from your end?
No, just really thanks, Ross and Linda, for the discussion. It's been really interesting. It's certainly interesting times, and I'm certainly going to be watching. Very interested to see how all these different, how the different sectors are valued, and what happens. I think we're at the commencement of another new era for self-storage, given what's happened in other sectors and the money that's out there looking for a safe home, and then coupled with you know, how the economy emerges from this COVID shock. Yeah, I sort of agree with you, Ross. I think it's going to be quite an exciting few years after once we get clear of the COVID drag.
Yeah.
Yeah, no, I'd agree with that, Rob. And at our board and our management team, we strategise, a pessimistic view, but we're certainly very much strategising a more optimistic view, and potentially even a sharp rebound as perhaps some demand has been deferred. Certainly some of that demand, the longer these shutdowns go on, may not come back. But what we saw in June, and not just us, a lot of operators just saw an incredible rebound in June. It was just fantastic, and discounting has disappeared from our dialogue in stores, and we're really pleased about that. So yep, we're optimistic, and great to hear that you are as well, and I'm sure our viewers are, wherever they are around the world in the different cycles of the economy, and this strange thing called COVID that's arrived on our doorsteps in 2020. So in closing, thank you very much, Ross. I really appreciate your time as always, and Linda, you're both very giving of your time and your knowledge to the industry here in New Zealand and Australia, and we greatly appreciate it. Rob, thanks for your insights too, mate, as always. Much appreciated. And again, for those watching, you can check out all the StoreCast interviews. We've done 12 prior episodes to this, and there's more to come. And we've got some special guests coming up from the sporting community who also happen to be investors in self-storage. So we'll get some different perspectives on business and sport over the coming weeks. But check out all the episodes at storelocal.com.au/StoreCast. Thanks again, everyone, and appreciate your time. Chat soon.
Thanks, Ian.
Thanks, Hans.
Thanks, guys. See ya.